Hey everyone, welcome back to Yuri's Box. In this video, I'm going to talk about credit spreads versus the Russell 2000. Someone is lying. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So I'm really revisiting the last time I updated this, credit spreads and small cap stocks. It's quite a while ago, so I thought it was worthwhile to actually revisit the idea here. And so just to go over things, credit spreads blew out. All right, they went from really a kind of historic low at really the 2.6. Well before, I think, even it was actually 2007 levels, if I'm not mistaken, just going off by memory. Yeah, May of 2007 and 1997. And again, credit spreads being this low is usually an anomaly, and it usually, well, an anomaly, I wouldn't say. I'll backtrack that. It's you usually see it before a kerfuffle, all right, as Jamie Dimon would put it. But really, why are credit spreads relevant? Well, they offer really a sneak peek of how corporate America is, its health is really. And I think it is, relevant to compare it to Russell, to put in relation with the Russell 2000 stock index. Why is that? So, again, just to bring everything home, what are credit spreads? Credit spreads, you're basically putting, making the comparison between a corporate triple B rated bond versus a treasury bond at the same maturity. All right. So say you're comparing a 10-year bond, a 10-year corporate bond, and a 10-year treasury bond, and you're basically measuring the spread. All right, between the two. A tight spread, meaning that there is a low difference between what you get, a lower yield on what you're getting on your corporate bond, is an indication of low bankruptcy risk, perceived in the financial markets, and therefore, because everybody's not afraid of these corporations going bankrupt, they're willing to stomach less premium, or really ask for less premium. And whenever credit spreads are on the decline, that is definitely seen as everything's fine, no reason to worry. Everything's great, and everything will continue to be great. All right. However, when credit spreads have a sudden move, that is generally an indication that financial conditions are probably going to tighten quite significantly, and most importantly, bankruptcy risk, perceived bankruptcy risk is quite high. And the basic argument is, if credit spreads were at record lows, as they were up until February and March, up to February, well, then why weren't small cap stocks outperforming? Well, you might say, yeah, well, I mean, hey, give the small guy some credit. I mean, we went from the lows, I had a 50% rally. Okay, absolutely. Just like the S&P 500 went from had a 50% rally, if I'm not mistaken, from in the exact time frame. Yeah, we were about 50% up. So you might say, where's the problem? Well, the problem is really that the S&P 500 had a 50% rally and actually went over its 2021 high. Small cap stocks, at best, were flat against this 2021 high. Hardly a great performance. Okay. And so again, if credit spreads are low, then why aren't small caps performing better? And one possible reason is that credit spreads perhaps are lying, and they have no business being this low, if the underperformance in small caps is to be believed. Right? If, on the other hand, credit spreads are correct in being right here, then basically small cap stocks should be outperforming. However, that is not what we've been seeing. Again, we've been seeing small cap stocks being flat at best. And they have actually suffered, if I'm not mistaken, even more compared to, the big tech stocks. We actually had, a 32% decline. When, I think the QQQ, and I look at NASDAQ, I think we were down 24 at best, 25. So again, small caps really got hit. All right. Now, everything's starting to kind of pick up again. There's some degree of optimism, mainly due to the fact that we're probably on the other side of the tariff drama, or most of the tariff drama, rather. And that now we're starting to get news of trade deals and yada, yada, yada. However, we still have tariffs. We still have a 10% tariff or 20% tariff. I don't remember, actually. It changes so many times, I lost track. But in any case, we still have to consider tariffs. And we still have to consider the effect that all this drama had on the economy. Economy that wasn't that strong going into it. And, I've made this clear in all my previous videos. We looked at the PMIs and, all the surveys, the business surveys. I went over the Beige Book yesterday. So, again, what needs to be the biggest question that still needs to be answered is how much damage has April and really Liberation Day done to an already battered economy, or rather battered. I'll backtrack that as well. I'll say to an economy that wasn't as strong and resilient as maybe a lot of people thought it out to be. All right. So as things stand, we actually had a credit spreads tighten ever since really the week of the week we had the blowout in yields, which again makes sense. You'd have credit spreads tighten. I mean, another way of visualizing this is just by looking at HYG, which is the high yield corporate bond ETF, and actually HYG is back at where it was pre-Liberation Day, right? And at the same time, we've had that massive sell-off in treasury bonds. So for the time being, things are looking, a little bit better, definitely. However, the big elephant in the room, as far as I'm concerned, is we already had an economy that probably wasn't that strong to begin with. How much damage has been done in the month of April? Also considering that if you actually look, let me see if I can find the financial conditions. We are still, definitely not at 2022 levels per se. This is again the Chicago Fed Financial Conditions Index, and we were quite loose. Again, at lower it goes, looser conditions actually are. But you can see we are a fair bit away from the lows that we saw in January. And we are back at levels seen in March of 2022 and 2015 going back. And let me see, 27. Well, actually right here in 2007, July of 2007. Again, what will determine if this continues to go up will just be if we have a spillover, say, in the so-called hard data. Meaning, if, say, next week's non-farm payroll report is negative, I would expect things to retrace and kind of that optimism get a bit, sucked out of the system. Simply because if we actually get the soft data spilling over into the hard data, that would actually answer the question that what's the economy looking like, right? And again, we could also have a positive non-farm payroll report next week, and things could reverse easily. I mean, this could easily be buy the dip moment. All right. However, given the fact that already conditions going into the Liberation Day weren't optimal, there is we have to go back and actually look at the fundamentals of the economy, and actually that is something that I've been arguing for a couple of weeks now, is that I'm speculating that we've left behind most of the tariff drama, and as we move forward, we'll actually be forced to go back and consider the economy and look at the real state of the economy, and that eventually will be the driver for further price action. If the economy is holding up well, then it will have been definitely a buying opportunity. If we get the opposite, meaning a negative outlook, well then expect more of the same. Okay. So again, just to summarize, well, we have had credit spreads kind of tighten a bit right here. I would still maintain my cautious outlook. All right. And simply because, again, we still haven't answered the most important question: how much damage has April 2nd done to the economy? If you like this kind of content, consider leaving a like, and I'll see you next time.